Hey, let's talk about audit and assurance, your favorite subject, and the topic of internal controls, which is guaranteed to be in your exam for many marks. You know that you will get a scenario question in the written section B, in which you will have to apply the knowledge about either control deficiencies, where you have to identify and explain them and give recommendations for improvement to the company, or direct controls in the company, which you have to test, or you could have both of these. So it's very important not just to know what these are, but also to be able to spot them in a practical scenario, because you know this is coming in your exam and I want to help you do better in that exam. So I created a poll on LinkedIn about a week ago where I asked a simple question based on a very popular thing that tends to feature in internal control questions, scenario-based questions. There is the question. It basically says there is a company called Steel Brainrot, and that company has employees which are permanent staff, and they're paid, as you can see, monthly by bank transfer, but also they have some temporary workers who are paid cash every week. And I just asked you a very simple question. What is this that I've pointed in my scenario, this little fact? Is it a direct control deficiency? Is it both of these at the same time, or is it neither of these? And you can see here, one second, let me show you the answers to the poll, what the majority of you guys thought. There you go. So you can see that most students thought this was a control deficiency. And now I think we need to chat about whether that is correct or not and why. So first things first, when we have a direct control, we are looking at something in the company that they do, a control procedure, control activity, something they do that in simple terms they do so well, a control that they actually perform really well, and that control that is very effective gives the auditors some confidence that the financial statements are likely to be true and fair. That is what we imagine when we see a direct control, something really, really good, that the company is doing a good control. While a control deficiency, on the other hand, is exactly the opposite. It is a control that the company is performing not well enough, a control that lacks something. So you can imagine it a direct control that fails at some stage. That's what a control deficiency is. So for example, a direct control could be a bank reconciliation, which the company performs every week or every month, that the financial controller does it, and then or maybe the clerk does it, and then the financial controller reviews that reconciliation and investigates any reconciling items, and then he signs his review to evidence that this has happened. That would be a direct control that is really, really good and could give some confidence to the auditor. A control deficiency would be where they don't do in the company bank recs, or maybe they do them but they don't investigate the reconciling items, or maybe they do maybe nobody reviews the reconciliation that is done by the clerk. And, it's just something that has broken along the line, so the direct control actually doesn't work as expected, and now it becomes a deficiency, which then means to us one thing. And that one thing is that when we have an example, it can't be both a direct control and a control deficiency. It has to be one or the other, or sometimes we could be looking at a scenario where we don't have either of these. But how a company pays its workers is not a direct control. Companies will have to pay their workers, and whether they pay them by bank transfer or they pay them cash, that is not a direct control. And it's actually not a deficiency either. Just how they pay, whether they pay by bank transfer, whether they pay cash, that is neither a direct control or a control deficiency. It's just how they pay their workers. And the correct answer to that poll was neither, which was only selected by 12% out of all the students who voted. And yeah, I know that most of you think it must be a deficiency, probably because they pay cash and you think cash is tricky to handle and so on. But for our AA exam, just cash payments to workers on their own are not a problem. Because of the practicalities, sometimes you might have to pay workers in cash, and that could become a deficiency depending on how you pay those workers, how you handle the cash payments. So, for example, if you distribute the cash but you don't validate who you give the cash to, if you don't require from the workers, say, some photo ID that is being checked, and then if you don't ask them to sign as well as evidence that they have taken the cash, then that will become a deficiency. But just because they're paid cash, that is not a deficiency. And also, if in the scenario you're told that the workers are paid cash and they sign and they show their photo ID, then that could become a direct control. But just on its own, it's nothing. Similarly, if they're just paid by bank transfer, well, that's nothing. That is not a direct control, okay? So just look at questions and look at how the workers are paid, but how the process, the payment process, the distribution process of, more particularly, the cash is completed by the company, and then decide whether it's a deficiency or direct control. Okay, I hope that helped you guys, and good luck with your AA exam.